Thank you, everyone. So I just wanted to start off with some primer on investment banking and why that really has become a buzzword. So anyone on what is your sense around investment banking? Why is that so critical today? Why is it that every fresher wants to build a career in investment banking? Yes, anyone. Why is investment banking so lucrative? Everyone wants to build a career in investment banking. What is investment banking in the first place? Like, if just anyone can just unmute and speak. What is investment banking in the first place? So basically, what is investment banking? It is a segment of the financial industry that deals with raising capital, providing financial advice, and facilitating complex transactions of entities. They are at times. So, for example, in Reliance, FB invested in Reliance Jio. Okay. FB took over WhatsApp. Then they took over Instagram. For all of these transactions, you have an investment banker in between, which is typically called the equity capital markets, ECM. And then you also have a DCM, which is debt capital markets. So every time a company raises funds, it generally would want to maintain a 2:1 ratio. So a lot of work will go to the debt capital markets side and a lot of work will go to the ECM side. Investment banking is basically the function of making demand meet supply. So in this case, Facebook was wanting to invest in India. Jio had Reliance wanted others to invest in it, and an investment banker in between facilitated the transaction. And then in investment banking, you have something called the buy side and sell side. So basically, when Facebook says, okay, I have $100 million check to write, please go out in India and find out which are the companies which are there in the technology space where we want to make a presence felt. So they will give a mandate, let's say, to Citibank to act as the buy side analyst. And then on the sell side, you might have, for example, JP Morgan, which advises Reliance as the seller of the shares that, okay, this is how you got to manage the entire transaction. So you got the buy side and you got the sell side, and accordingly the whole transaction happens. So what are the core functions of investment banking? They help companies access public market. So for example, there is an investment banker which will be behind Hyundai IPO as well. Whether it is through an IPO, whether it is through a secondary public offering, which is also known as FPO or rights issue or preferential issue, all of this collateralized loan obligations, and then complex structured financing. So what is structured financing? So for example, you might have a convertible note, you might have a warrant, a preferential issue structured in such a way that you are able to raise funds for corporates the way they want. And then that's raising capital. And then you will also advise people on buying, selling, on merging entire business. That requires a lot of financial modeling, lot of negotiation, and then regulatory navigation. So for example, if Facebook wants to invest in India, there will be a FEMA implication here. Then you'll have a Competition Commission of India, CCI, which will have its own share of things. So for example, if Adani, if you read the newspapers, in Adani wants to invest in Holcim and wants to become like the number 2 cement player in India. So that is going to reduce competition. And because of that, a lot of implications around Competition Commission of India also comes into the picture. And then you've got FEMA as an implication which comes in because clearly there is cross-border transaction involved, and hence that is also going to be required. And then strategic advisory. For example, financial restructuring. A lot of S4A in India happens where companies are able to go for debt restructuring because they are not able to raise the funds properly, etc. Means, so a lot of infrastructure companies eventually could not do well, and then they went for S4A, which was like rescheduling of the loan, and then you have companies which go to insolvency, bankruptcy code, which is basically you have an insolvency bankruptcy code in India called IBC 2016, under which the deals like SR Steel happened. Who purchased SR Steel? SR Steel, they had a huge 50,000 crore plus of loan from the bank. And then what happened was that they were unable to pay that. Banks took them to the insolvency proceedings under the IBC 2016. And then ArcelorMittal bid that. So that became another M&A transaction of sorts. Then you'll have Bhushan Steel, which was taken over by JSW. One Bhushan was taken over by Tata Steel. In all such situations, you will have someone who is advising the buyer as a buy side IB. And then in this case, it was under the insolvency bankruptcy code, and hence there was no IRP involved. But that is also something which is of a critical importance. And then you also evaluate brokerage, new issue distribution, etc. That also becomes part of investment banking. They have the prop books for which they kind of run that prop book to generate gains for their clients. So that is the JM Financial Wealth part, which is also in a way investment banking. Now, generative AI, so if you look at the trends in investment banking, what will happen is that decision making will become far more robust with the help of a machine learning and AI. So you will have like a 10,000 simulations which can happen around what could be the way investors perceive our investment decision. And accordingly, that simulation happens and you are able to forecast in a much better fashion. So you have a generative AI, which will be a major player in investment banking, unlike any other industry. So customer service, investment decision making, operational efficiency, all of that improve in a big time. And then higher interest rates. In order to handle the current market volatility, strategic realignment of raise rates, all of this will happen. Digital engagement. So banks will also have to employ data analysis. In that, you'll have to employ artificial intelligence, and then personalized financial services. You'll have to have artificial intelligence. And then a lot of trend is also happening around ESG. So when you talk about investment banking and the upcoming trends in investment banking, you will find that ESG comes in a big fashion. Environmental, social, and governance thing. So this trend is a continuation of the fundamental shift in the ethos of financial decision making. And then things like decarbonization, etc. So those are broad trends, but that's not really the moot point which I would want to emphasize today. The idea here is to tell you that, okay, investment banking is a big thing. And then how do we enter investment banking? By acquiring skills which are pertinent to the world of investment banking. And for that perspective, you can just see that there have been huge number of deals, like 40,000 deals happen in a year in the whole world, where just there would be like 2,700 deals in a year, 2,700 deals. Now we have 39,600 deals in 2023. In 2024, up to May itself, 13,000 deals have been executed. Who are the big guys here? Rothschild, Goldman, JP Morgan. If you work here, you are there. And then Goldman Sachs was the leading M&A financial advisor in terms of M&A deals, while Rothschild was leading in terms of the number of deals. And Goldman was the top guy in terms of deal value, and JP Morgan was in terms of revenue from investment banking. Which means what? JP Morgan fees is highest. They charge the most. Now, how does one get into these places? That's a different discussion related to what are the educational qualifications that one might want before they get here. But the volume is like huge. Anyone and everyone will agree to the fact that investment banking as a function is here to stay. You need the deal maker, just like in a typical marriage between the husband and the wife, you have to have a deal maker. Here also, you will have to have the deal maker who brings in that value add in terms of the how does the buyer buy, how do you do the valuation, how do you prepare the financial model, is there a due diligence aspect to it which is very critical. So 2023 in India had 1500 deals. $53 billion was the thing. Although it was a lower number because 2023 was not one of the best years in terms of investment banking, but still there was a slight increase in cross-border transactions. 120 transactions became 140. So whenever there is a cross-border transaction, for example, there is a FEMA implication as well. So their collective value sharply declined. And then P activity also, there were like 1000 deals. So in M&A, you could have an M&A, you could have a venture capital, private equity, or an angel. A lot of folks could be actually getting this whole thing done. So then you had in the major deal which happened this year was the merger of Reliance and Disney, which valued the company at $8.5 billion. Okay. So you have Parfios, Krutim, SI Designs. These were like startups which became unicorns. So unicorn is basically an animal which is rarely seen. And hence, to think of a startup commanding $1 billion of valuation is something that will be fairly there. So you will have a lot of M&A transactions, P deals, which will keep happening. And that's where we will have like a Reliance Media merging with a Disney, a Tech Mahindra doing an internal consolidation where they have all of these companies like Perigord Media, Perigord Data Solutions, Tech Mahindra, Cerium, all of these were merging. So that also in a way is investment banking. So then Reliance Industries acquired the Future Group's retail, wholesale, logistics, warehouse businesses. Tesla and Tata Motors decided that okay, in Tata Motors, there's an electric vehicle division. Tesla will acquire that for $2 billion. So these are the kind of deals which happen here, which are phenomenal in nature. Tata Group then acquired Air India, and then merged Air India with Indian Airlines and Vistara to create a behemoth. And then Adani acquired NDTV following its purchase of an additional 27.26% stake, reflecting the conglomerate's growing interest in the media space. Okay, so Zomato Blinkit merger happened, then Brookfield invested in the realty companies. So from that perspective, in the world of investment banking, a lot of action, as we can see from what we have discussed so far, happens. Who are the big guys here? So the major names are JP Morgan, Goldman, Morgan Stanley, Barclays, BNP Paribas, Deutsche, Bank of America, Merrill Lynch, UBS, SG. And then in the Indian markets as well, you've got a lot of firms like an ICICI Securities, Axis Capital, Kotak, IIFL, Centrum, O3 Capital, Edelweiss, Avendus. Now, Avendus is a big homegrown firm, which, especially in the world of startups, does a lot of work. So, from that perspective, all of these big tier companies are doing work, which one needs to see that. So, there will be a strategic need for M&A, for P funds which want to exit, IPOs to happen. So you will have like a Swiggy IPO coming, a Hyundai IPO which has opened today. So from that perspective, the first thing that we need to crack here is that what are the skills which are required. And in the world of investment banking, in terms of hard skills, the critical thing is FM, financial modeling, valuation, and then due diligence. And then soft skills will require a lot of negotiation. Your people skills have to be really very good. So to be, this, you will generally learn it on the job. And this, generally companies expect that you should have very strong understanding of how a financial model is prepared. The financial model could be a basic DCF model. It could also be a leverage buyout. What is a leverage buyout? Anyone? What is the meaning of a leverage buyout? Any participant can unmute and speak. Leverage buyout is basically what happens in the case of an LBO, is that the company's management itself takes over the company by taking debt on the books of the target. That's a very big thing, that there are the books of the target which those guys then are able to use. So now what does this exactly mean then? And how does, so these are the kind of structures which happen, that there are LBOs in the country because of which you will have, because of the leverage buyouts, Tata Chorus deal, kind of these deals happen where the management of the company is taking over the company by taking debt on the books of the target entity. Okay, so far so good. So you will have a lot of LBO as well, which comes here. So to continue the slides, what is a financial model? It is basically an analytical tool that we design to forecast a company's financial performance based on its historical data, assumptions about the future conditions, and then strategic decisions. So without a financial model, it is practically not possible to understand how much you are going to bid for that entity. Like recently, I've been advising one company on how much they should bid for a mining of a coal auction. So there's a lot of commercial coal auction that happens in India, where there's an entire block which the government says you take over. In return, you bid for how much you are willing to pay to the government as a on the revenue share. Okay, so from that perspective, you will need to have a very strong financial model. There are three aspects to the financial model. You will have an income statement, you will have a balance sheet, and you will have a cash flow statement. So all of these three things will go together and help you get the thing. So it shows revenue minus expenses. Balance sheet shows basically a statement of assets and liabilities, and then cash flow shows how much money will flow into the company and how much money goes out. This is on a very basic fashion, that profit, balance sheet, assets, liabilities, and then cash inflow, outflow. Why will there be a difference between an income statement and a cash flow statement? Because sometimes, let's say you pay, you send someone goods on credit, they don't pay up. So you will book your profit in your profit and loss account because the revenue recognition target is met, that okay, I have sold it, so it works. But the money does not flow into your bank account, and hence your cash flow will remain zero. Although you might have said, okay, I have booked $100 of sales, but my cash flow will become zero. And because of that, you feel happy, okay, I have a profit of, let's say, 50 on that 100. But my cash in the pocket is zero because the money has not flown in and my creditors are chasing me. So when we do valuation of a company, the most critical statement is not profit and loss account, not balance sheet, but cash flow. Because in the cash flow statement, you are able to understand how much it is actually able to earn and then translate that earnings into cash. So a lot of times you might just book a lot of profit in your books by just sending a lot of material to your customers, but they're not paying up. And therefore, the cash flow you will have something called an operating activity, investing activity, and financing activity. So there, what you will happen is that in operating activity, you will plot how much the company is going to generate from its core business, जो धंधा है, जैसे for example PVR. So PVR, cash flow from operating activity, will be like, just to give you a case in point, we'll just pick up, let's say PVR. We'll go to screener. So this year also major deal happened in terms of PVR Inox deal which happened. So if you look at it, we'll just look at the cash flow statement. Huge, but yeah, investment banking requires you to have the ability to read these financial statements, the notes to accounts, the policies, the detailed annexures, because that is where you will get the entire, see, you've got the consolidated P&L account, consolidated balance sheet, and then consolidated statement of cash flow. So what happens is that you have, let's say, a loss, then you adjust it for all things like depreciation, amortization, because these are non-profit, non-cash in nature. So therefore, all the amortization that you have done, you will remove it from your books. And then interest income, impairment, finance cost, all of this you'll reduce, and you see there is a loss in the book. So of 439 million, means 43 crores of loss is there, but cash generated in the books is 1857, which means that the financial model should be able to forecast that where exactly are things happening. So this is basically cash, and then you adjust it for working capital items like trade payables, inventory, financial assets, etc. And then how much are the taxes that you have paid or got a refund. So you got like 2000 crores is what it has generated from operations. Whereas in the books, it is showing a 44 crores of loss. So then you've got a cash flow from investing activity where you purchase property, plant and equipment. So these are all the cash outflows that you'll have to forecast that, okay, the company this year has purchased a lot of property, plant, equipment, etc. It has sold some stuff. And then you've got financing activities where the company repays borrowings, like it would have taken some loan from the banks, it would have repaid all of that. And then it would have, oh, I have not shared the screen. No, so sorry. Yeah, sorry. So if you look at the PVR, what happens is that you have basically the balance sheet, you've got the statement of income and expenses, which we are going to plot through the financial model. Plus, you also have the statement of cash flows, which is very, very critical. What happens is that you've got a loss of 44 crores, but that loss of 44 crores eventually results in like a 2000 crores of cash from the business. How is that possible? Because in your books of accounts, all of this depreciation, all of this amortization of intangible assets, right of use assets, that was non-cash in nature. Really does not matter, because from a cash perspective, you lost no cash. It was just an accounting entry that was made. And from that perspective, the depreciation of all of these huge aspects will not impact your cash flow. So then you got forex, foreign gain, loss, finance cost, etc. So it becomes like 2000 crores of cash has been generated from the business. And then the business has also purchased 650 crores from property, plant and equipment, proceeds from sale of property, plant, etc. So that becomes the net cash flow from investing activities. And then you will have a rights issue. Maybe you'll have done some fresh issuance. You'd have done borrowings, etc., short-term borrowings, long-term borrowings, etc. So you've got a financing cost. Financing also 1,300 crores is the outflow. You've repaid a lot of loan that was there in the books. Now, when you make a financial model, you actually forecast how the company is going to do that in the future. So, for example, maybe I can just open any model. So I can actually look at a company and say that, okay, boss, this is the revenue for the company, how this is going to be there for the next so many days, and how much will be the EBIT, taxes, etc. All coming down to, okay, this is the enterprise value of the business. So a cash flow model will eventually help us understand how the profit of the business will be there. Okay. That's about a financial model. So coming to that, you have the income statement, you got the balance sheet, and you got the cash flow statement. So you got a historical data, which is information from the past financials that are being used to build up assumptions around cost and all. And then you've got hypothetical assumptions around how much is the sales growth, what is the market sales growth, etc. And then projections, like you can make a financial model for PVR that, okay, today where it stands and how it's going to perform in the next 5 years. And on the basis of that financial model, then decide whether you want to invest in the shares of PVR or not, whether someone wants to invest in PVR. For example, Disney wants to acquire PVR in India. How will it will do a valuation? It will look at the past financials of PVR, look at the potential of PVR in terms of the whole financial model, and accordingly, it is going to then decide whether it is going to give a valuation to PVR at what level. So the models which will be there will be one DCF model, which is a discounted cash flow model. Then you'll have an LBO, which is a leveraged buyout, where what happens is that you will have a significant debt that is taken over by the company on the books of the target entity. And then you've got, of course, M&A, where in M&A, there's an interesting thing called synergy. So what happens in synergy is that in case of synergy, what happens is 1 plus 1 is equal to 11 in a way. How is that possible? You will say, sir, how is 1 plus 1 is 11? But yes, sometimes, for example, PVR has got an extensive food portfolio. In terms of, it has now become a household name in terms of popcorn. People are generally liking PVR. And there's a company which is into food distribution like McCain. So McCain and PVR, if they join together, then McCain's products will be sold in the PVR outlets. PVR's popcorn will be sold in McCain, and therefore 1 plus 1 with maybe 11, maybe 5, maybe 7. A lot of activities will happen, which will create something called synergy. And then the most important thing is sensitivity analysis. So let's say if I do a financial modeling for my decision to offer some course, there'll be a base case where I'll say, okay, 30 students will opt for my course. Then I can say that, okay, a very good scenario could be there could be 50 people who have opted for it. And then there could be a situation where only 20 people have opted for it. So there could be different scenarios, how many students opt for a particular class. So that also is sensitivity analysis. Like in case of a PVR, what will be the sensitivity around? It will be around occupancy. That will depend on, let's say the key driver will be number of super hit movies, number of hit movies, like that. Any questions so far from the participants? Yes? Okay, then we'll reserve it for the last 10 minutes. If there are people who want to. So financial model is going to be an Excel that is going to be projected, where you will be able to understand how I will be able to value the company. So I think you all are going to get a recording of the session. So that should be good enough for. So you kind of build a forecast around what is the revenue of the business. And then you also do valuation in terms of, okay, this company has an EBITDA of 30 crores. The listed companies in this space, like Aditya Vision or Electronic Mart, because this company sells TVs. TVs ka retail, basically all of these large short companies. So TV retail happens. So you got an EV EBITDA as a metric, you got a price to sales as a metric, and then you got a price to earnings as a metric. So what happens is that you'll say, okay, these companies are trading at 26 times as an average. So if I apply 26 times on my earnings, my valuation will be 813 crores. Because I have got some debt and cash in my books, my equity value will become 741 crores. Similarly, if my sales is 301 crores, my average price to sales based on the competitors is 2.22. I will apply this and I will get like 600 crores of valuation here. And then on a P ratio basis, my average P ratio will be 54.64. I will do like on a part of 13 crores, 54 times, it becomes 735 crores. So then I can value the company at roughly 700 crores is the number, 734 crores, 741 crores, 667 crores, like that. Okay. So that's how the cookie crumbles in terms of valuation. So coming back to our, so valuation, when is valuation needed? Why is needed? So example, the purpose could be transaction. It could be accounting, like you could do a fair valuation of a company. You could have a purchase price allocation where valuation is required. And then a lot of Companies Act requirements are there where you have to do a preferential allotment, a merger. In case of investment banking, the transaction purpose is always either you want to do a plus where you want to acquire a company or you want to sell a company. And for each of this, you'll have to do a financial model, which is, let's say, a DCF model, or you do some comparable company method. Like on the comms, we saw those retail company में. So that will be done through a valuation exercise. So that will be a buy side valuation where you want to arrive at a transaction value. And the company B will want to arrive at a sell side valuation. That what will be the valuation of the stake that it is selling. So let's say I am a company which wants to exit India. I will give a mandate to an investment banker, boss, I just want to sell my stake and exit the country. The investment banker will do a valuation through a financial model and let me understand what will be the transaction at which this can happen. So normally the approach here could be net asset value or equity value, market approach, comparable companies, comparable transactions, or then DCF, discounted cash flows, projected cash flows discounted at WACC. So enterprise value is equity value plus debt minus cash. So for example, you will have different cement companies, Ultratech, Shree Cement, Ambuja, ACC, JK. You've got different EV EBITDA. On the basis of min max average, you will say, okay, 11.3 is the typical thing. So for example, therefore, if there is a company which has an EBITDA of 100 crores, what will be the value of the company? It will be 100 crores into 11.3 is equal to 1130 crores. So that will be the enterprise value. And then what will be equity value? if the company gets sold, the first value in that company is going to come to the debt holders. So you will reduce debt and therefore come at, so my enterprise value will be there. From there, I reduce debt to get my equity value. Okay, so equity value can be on the basis of the numbers reported. So typical DCF, where I'll do an EBITDA, I'll do my taxes reduction, working capital reduction, capex will be reduced, etc. So free cash flows to the firm will be there, and then discounting rate will happen. We got the present value of the cash flows, and you reduce debt, add equity. So add back cash, you'll get the equity value. Then what you can do also in adjustments related to valuation is discount for lack of marketability, discount for lack of control. Why would that be? For example, maybe I'm not purchasing the entire company. So I will not get the controlling stake in the company. So from that perspective, I will do an adjustment for lack of control that I will have in the company. Similarly, I'll do an adjustment for lack of marketability because it might be an unlisted startup. So as compared to a TCS or an Infosys, this is an unlisted company in the technology space. So then I might not really get that same valuation. So I will do discount for lack of marketability. Then there'll be a discount for lack of control. So valuation is an economic concept on the basis of which you figure out how the buyer and the seller of the goods are willing to come to a common ground. Valuation and price are not the same. So sometimes something which is worth 100 rupees, you will pay 150 rupees because you really need it. Something which is worth 100 rupees, you will be able to sell it for only 50 rupees because you really need that money, which is the often happens in properties also. So in M&A, in investment banking, it is valuation and price will be different depending on how the negotiation happens. The transaction happens at the negotiated prices, and therefore it will be like a part art, part science, depending on the purpose, the time. So whether it is a desperate time for you, when you will get the best value, when there is no hurry. So from that perspective, you will broadly from any financial model only get a range of fair value. Uncertainty is a given in a business situation, and herd mentality tends to reinforce biases. So today everyone wants to invest in the Indian stock market, but it could be a fact that it is just herd mentality which is there, may not really be the right thing to happen. Okay. Yeah. So which is the most preferred valuation model which is used by investment banker is what the question is. Balaji has said. So I'll answer it live. I'll just remove that screen. Yeah. So basically the preferred valuation method used by investment bankers will be a mix of DCF and comparable company method that we saw. So normally what you will see that, okay, if it is a media company, it is trading at 10 times normally the valuation, 10 times EV EBITDA. And hence we will look at something in that range if we want to get that transaction. If there is an urgency on behalf of the buyer that, okay, I really want to get into in India, so I'm happy to pay 12 times, 13 times, fine. So then there'll be people. So then comparable company method, the model will be further adjusted for the upside. Then what different types of financial models, including advanced, are there and where to learn from? So there are different kinds of financial models, like a DCF model is there, which is the most important thing. There'll be different kind of scenarios where financial models can be used. So what happens here is, DCF, then you will a lot of scenario planning, etc. There'll be data tables, goal seek, industry M&As will be there. Then there'll be like a due diligence which will happen. That will also impact the valuation of the company. That will be there as per the financial model. How is a startup's financial model different from a brick and mortar company? So those are the things that you will want to see. So where should we learn from? Yeah, so basically what you can do here is, like I have a course on Taxmann that will be coming up in the near future, where we might actually offer financial modeling, valuation, due diligence, that whole investment banking as a masterclass. Then there are books, etc. I write a lot about all of this on my LinkedIn channel, so you can write there as well. You can follow me, Anurag Singal, on there, and yes. Any other questions are there? So if you talk about due diligence, so what is basically due diligence? What is FDD, financial due diligence? There are three types of due diligences which happen. One is a legal due diligence, where you look at an entity when you want to buy, you want to check whether or if the legal compliances are in place or not. So covers a wide scope of legal matters, including incorporation, ownership, contractual obligations, etc. Then there's a commercial due diligence where you look at the business and understand that, okay, let's say the company has forecasted that it will become 1,000 crores in 5 years. Does it make commercial sense that the company will achieve that number or not? So from that perspective, that's an independent perspective on the sales forecast. That, okay, this is the business plan which the company has created. Is it really worth that thing? So the investors investigates, okay, where are you in the market? So do people in the country, in your city, prefer a McDonald's, or they prefer a Burger King? Do they prefer homemade? So from that perspective, people investigate your market positioning, your market share, the drivers, future drivers, what could be the future. So like in the auto space, if someone were to do a commercial due diligence on Hyundai, they will say, okay, the company has got a good presence in the diesel and the petrol operated space. But when it comes to EV, the company might fall behind Tesla, etc., because its products are right now not as good, or maybe not as popular in the market. Similarly, in terms of EV scooters, if you do a commercial due diligence, you will understand that, okay, Hero scooters have this pros and cons, Ola have this, then and Ather scooters have this pros and cons. And accordingly, once you make the forecast, you'll say, okay, this small company which wants to sell scooters in Andhra Pradesh, this could be the growth trajectory for this company. And then financial and tax due diligence, may you kind of you check the valuation assumptions which the company is sharing for itself by looking at the past performance, looking at the future, etc. And then you will identify the financial risk and the uncertainties around the business. And then you will also have a tax due diligence. What is the tax due diligence? You will look at the past compliances and try to figure out whether the company has been complying with the income tax, with the sales. So recently, when we did a due diligence on a company, we found out that there is a 5 crore rupees of outstanding demand because there was a litigation. Now, on a deal value of 100 crores, if 5 crores is outstanding, which means if I end up buying the company, I will also acquire that company, all liabilities, lock, stock, and barrel. And hence, I will end up also getting those 5 crores of additional liabilities. Hence, an M&A can never just happen in Excel, where just some people, but the buy side comes up with some Excel, the sell side comes up with Excel, and life is set and sorted. It will never happen like that. You have to do a proper due diligence on the financial aspects of the company, commercial aspects of the company, legal aspects of the company, etc. Right? So what you will say, you will understand that what are the key risks that are there in the company at the due diligence stage, which could be regulatory. For example, if it's a gaming company, so if I want to acquire a gaming company, there could be a lot of regulatory events around that. There could be political, environmental issues, social legal issues. Then investor will also look at alignment, whether okay, so the alignment of whether the company's goals and the objectives align. Funding strategy. I will say, okay, I'll acquire this company for 1,000 crores. But what if I don't have the money? So what is my funding strategy? A lot of companies will say, okay, we've got enough cash in the books. A lot of companies will say that, okay, we will acquire, take debt. They will do a rights issue and acquire funds. Then what is the team ref check with respect to who are the key people in that company which will be doing that? And then financials, where you will look at the growth, the cost drivers that are assumed in the financial model, which translates into operations of the company. They evaluate the feasibility of the company, hitting the assumed valuation and revenue targets. Investors seek to understand the burn rate and runway their investments will give to the company. And then what will you check? You look at product or the service that is being offering in terms of market fit. You wanting to sell a fridge in Atlanta, Antarctica. It is not possible. But if you want to sell a fridge in a desert, yes, there's a lot of market feasibility there. Then competition, whether it is bullish, bearish, all of that. Then market opportunity. What is the total market size in terms of TAM, SOM, SAM? So then they develop a POV of the company based on their assessment. Then technology, whether company is actually using technology rightly. What is the tech stack? Is it the right stack? Whether it will help the company grow into new markets, etc. Like our website was for a long time built on old .NET and Java. Right now, new stacks have come up like React Native and all. So that technology due diligence happens, and then companies are able to come up. Then media perception. How is the company being perceived by the media at large? So, for example, Hyundai today will have a lot of negativity that at some point of time, Hyundai Pakistan had expressed solidarity with the Kashmiris, Pakistan Kashmiris. So that means that's a media perception. So then today, the IPO of Hyundai, a lot of people will say, I will boycott the IPO because they are not loyal to India. And then litigation, whether there are any pending litigation cases, IP, regulations, contracts, etc. So therefore, a lot of due diligence will happen around all of these financials, major contracts, sale agreements, supplier agreements, debt agreements, etc. Services portfolio, all of this intellectual property, all cap table, warrants, debt holders, financials, customer portfolio, all of this will have to be very quickly understood. So conduct a DD on the investor, agree on the confidentiality, in make quality transaction advisors, agree on the scope of the DD. So that will be the way the things happen. Yes. Any other questions for the last 4 minutes that we have? It's a very exciting world. M&A, so you see the kind of deals which happen round the year in the world of M&A in India. HDFC happened, then Geo deals happened. So these are information that you will get online. It will be strategic. It will be P, inbound, outbound, freely available material on the information. Which sector is hottest? Financial services, TMT, technology, media, telecom, energy. Where is the growth happening, not happening? And then what are the factors affecting M&A? Focus on core, diversification, restructuring, where companies want to grow volumes, they want to grow value. So a lot of interesting things are going to happen, and the investment banker will have to look ahead of the curve and try to see that how he or she can capture those trends and add value to the buyer. So often you'll see that these investment bankers will come to a company CFO and say, okay, hey, there is this deal, there's this company wanting to sell, and so would you be interested in this company? We think that this could be a good strategic fit for you. Then one question Krunal has is, why are there multiple investment bankers involved in an IPO? Because they do underwriting. That risk sharing, such a large IPO cannot happen by an individual person. So they kind of do it. And then you see 2, 3 names, Kotak, JM Financial, etc. You'll also feel a sense of comfort around the whole thing. There's some books on financial modeling and due diligence process. I think a live course or an internship really will help a lot here. In terms of books, I think I have one book on financial modeling. You can search online, and there's a Udemy course as well. You might want to check that. But yeah, we are launching a master class, hopefully. IPO, I don't think there are any books on IPO preparation. Merchant banking, for that, you'll have to work at merchant bankers and try to understand how the typical day in the life of a merchant banker passes. Yeah. Any books on IPO preparation? Yeah, there will be that typical merchant bankers. You have to look at top-notch merchant bankers in the country and try to see whether you can work there and get that done. Yes, any other questions? Okay. How could you please share the recording of the session? Yes, that will be shared, I think, by Taxmann. DD is a although very wide scope. How to do it within timeline? Yeah, that is generally you will take, depending on the scope, it is defined that okay, in 2 weeks you have to complete DD, 3 weeks it is up to a lot of night outs are happening in the DD. That's the whole thing why DD is a tough aspect. Because stakes are very high. Based on your DD, the company's board decides whether they will go ahead with it or not with the deal. So yeah. So team Taxman, then I think we are done for the day. In case there are any questions, you can always send it to me on LinkedIn as well. So this is my LinkedIn handle. You can send it there. You can send it to Taxman team. They will send it to me either ways. The idea behind our master class will be that we will teach how to create financial models, how to do valuation, look at real life situations where you look at data and come up with insights regarding diligence, etc. That's how it will be. Okay, sure. Okay, then. What are the DD generally done by investment bankers? They will do financial due diligence. They will also not do financial due diligence. They will get it done by companies which specialize in financial due diligence. Like my firm does some FTD. There'll be big four, big six firms which do FTD, etc. Thank you.